Yo, what's up, guys? I'm going over 3 dividend stocks that I will never sell for the rest of my life. And these are, in my opinion, very high quality companies. And it's actually none of the stocks I own in my Robinhood account. So I'm allowed to buy and sell these stocks in here. I most likely won't sell any of those holdings, but we're actually going over to my Moomoo account. Where once I buy a stock in here, I'm literally never allowed to sell it for the rest of my life. So if you come back to my channel in a year, 2 years, three, I will still be making videos and I will never sell any of these holdings. I will just keep holding on to them. And you can see our total position profit and losses. We're up $873 all time. And here are all the stocks in this portfolio. And I want to just go over my top holding first. This is ticker symbol POWL or Powell Industries. And I cannot believe how this stock is done. If we actually zoom out and just look at this, they are up 13 days in a row. And these aren't average candles. These are, the real candles. They are up 13 days in a row. And literally today, they are at a new all-time high. So what better day than today to make a video about them? And here's why I still think well, first, I can't sell them, but even if I was allowed to sell my shares, I wouldn't because of this PE ratio. Look at this on the left here. They're literally trading at 20 times PE ratio and a 17 times forward PE ratio, which is still cheaper than the market, in my opinion. And let me go ahead and show you what their financials look like. So just first off, look at their net income. This is like the best thing you want to look at, in my opinion. And look at their net income. It's literally exploded. It's up 150% year over year. They're at an all-time high net income, record net income, which is crazy. And it's not just their net income. Look at their total revenue. This is an all-time high record, sales. It's $288 million in the most recent quarter. But look at this number, $46 million in the most recent quarter. And they also pay a dividend. It's a very, very small dividend, but it only cost $3.18 million. So their payout ratio is literally like 5%. So they have so much room to organically raise their dividends if they wanted to. And on top of that, look at their short-term investments. So this does not include their cash. This is their short-term investments in like treasury bonds. It's $42 million. So $42 million plus $332 million of cash, up 81% year over year. This is a record amount of cash they have on hand. On top of that, I forgot to mention that this company is completely debt free. They have zero debt, so that's not even anything we need to worry about. On top of that, look at their diluted normalized EPS. It's kind of hard with these year over year growth rate numbers, but it was $3.79 in the most recent quarter. And like I said, their dividend cost 0.265 cents a quarter. So their payout ratio is literally nothing. So that's why this company right here is my largest holding. And I want to show you a quick slide from their investor presentation because this company is backlogged like for the next year with orders that they can't even fulfill yet. So let me go ahead and show you that. All right, so here's their investor presentation, and look at this backlog right here. Look at the year-to-date backlog. It says they have a healthy backlog booking into fiscal year 2026. So that's what's kind of crazy. We can kind of see the orders versus their total revenue, it's really impressive. And most of the revenue does come from the United States, 84%, but they do have some international exposure, 16% of total revenue. They're the electrical standard. And where does most of their revenue come from? Well, the oil and gas industry, petrochemical, electrical utilities, and on top of that, they're seeing an increasing demand for data centers. They make custom engineered electrical solutions, which sounds a little confusing, but right now that is a industry that is getting a lot of new buildup because of all the data centers and stuff like that, and the increasing electricity demand. And look at this. This is their income statement. Look at their SG&A expenses. This is what's super impressive. Their expenses are flat, literally the same. So far, year to date, it's 70 million. And look at their gross profit. Year to date, 193 million. Look at their EBITDA, their backlog, and their EPS. I mean, this is just so impressive, this company. And their cash and short-term investments is at an all-time high. Like in 2019, it was 125. Now it's 374. And this is a super important metric I like to look at, the return on equity. It's a 23.8%. So that is nuts. I mean, they are just cranking out money. And that's why the stock's at all-time high. I literally hit an all-time high today. So that's what's crazy. So here are their primary end markets, LNG, refining, petrochemical, pipelines. And this is their new exposure to the commercial industry, which includes data centers. So they are seeing some data center exposure. They make all these custom engineered parts. But yeah, that's why I love this company. The increasing demand for this industry is why I love them. And last thing about this company, since they have zero debt and a bunch of cash, they're not paying any interest on their debt. So instead, they're making interest on their cash. And in the most recent quarter, they made $4.51 million in pure interest, literally just interest from their cash that goes straight to their bottom line. So that's what I love about these companies that are debt free with tons of cash. They made $4.5 million of pure interest in the most recent quarter. And remember, their dividend cost $3.18 million. So they're literally making more interest than their dividend cost every single quarter. So that's why, I mean, it's a no-brainer. I'm never going to sell that stock. We're also up 171%, so I don't imagine it would ever even get close to my cost basis. Yeah, we literally bought all our shares this day. Let me see if I can like actually look at that. So yeah, this is when we bought all 12 of our shares on this exact day. And we didn't really dollar cost average. I dollar cost average into this stock right here and some other stocks. But let's go ahead and get to the next dividend stock I will never sell. And it's actually a stock I bought today. So I wanted to save the most interesting stock for last. But this is Disney stock. And I also bought a share of this literally today. I deposited some money. Actually, you can actually see exactly where I bought it. But our average cost basis is basically at exactly $91. And let me show you why I love Disney stock. So first off, we can just go and look at their free cash flow metric. And when you add up the 4 most recent quarters of their free cash flow, you get $8 billion almost exactly. And they're trading at 21 times that number. So they're trading at 21 times free cash flow. But let me show you something that most people don't like about Disney. And here's why I really like Disney. So if we look at their PE ratio, it says they're trading at 35 times earnings. But if you look at the forward PE ratio, they're trading at 19.5 times earnings. So the forward PE ratio actually makes sense, but here's why the trailing 12 months PE ratio is so suppressed. Look at their EPS, the trailing 12 months. Look at this. They literally had negative EPS last quarter. Like in the most recent quarter, they made $1.40, but they lost 1 cent the quarter before. And let me actually show you why I don't actually like to look at that. So that was their normal EPS. Now let's look at their diluted normalized EPS. And if we look at this number, they have never been negative. And look at how they're slowly growing their diluted normalized EPS. This is what I like to look at. And then when you do a multiple on this, they're literally also trading at 21 times the trailing 12 months diluted normalized EPS. So if you look at Disney from their diluted normalized EPS point of view, they're actually trading at a very fair valuation right now. They also have $6 billion of cash on hand. So look, they have $6 billion of cash, which looks really low right now, but also look what they just did. They just spent $1.5 billion on buybacks this quarter, $1 billion on buybacks before, and check this out. They also are down on their debt 11% year over year. So last year they had $44 billion of debt. Now they have $39 billion of debt. So it's good to see that Disney is paying off their debt. If they can afford to spend $1.5 billion on buybacks, they can afford to instead buy off debt with that money. So this company really is cranking out free cash flow, and that's why I hold Disney. They also just reinstated their dividend, but they actually pay you 2 times a year. So they don't pay you quarterly, they pay you bi-quarterly, I guess, if I'm saying that right. And the dividend yield isn't much. It's 0.81%. But again, I expect that to grow. And we can see how the stock price has just fallen recently. They also have some exposure to like the cruise line industry, which a lot of people don't like. And I actually totally get if you hate Disney stock. I totally get that because most people do. But I just like looking at Disney. Look at their free cash flow per share. This is a number that I like to look at, and it's insane. So here's Disney's numbers and their valuation. So check this out. They have a forward PE ratio of 18.2, and PE ratio is just net income, so a net income multiple of 18.2, and a price to free cash flow ratio of 21.39, and a price to earnings growth ratio, which adds in a growth rate of 1.27, which is just very cheap in my opinion. Like, that's actually nuts. And if we go to the free cash flow, look, the free cash flow per share of $4.38 just this year, and the stock price is $92. So yeah, if you just take $4.38 and you times it by 20, then you should get what the stock price is today. And lastly, I'll be super quick about this for Disney stock. So look at this. As you know, they own all of these streaming services like Disney Plus, ESPN, Hulu, ESPN Plus, and their combined streaming services businesses were finally profitable. So check this out. They used to lose money on you as a subscriber, and they're finally now making money. It improved $550 million and to now positive $47 million. So this is very impressive. They're finally making money on you as a customer. So that's why I like Disney stock. They have a lot of other good slides from their investor presentation. So I recommend if you want to buy into Disney stock, go ahead and check out this investor presentation. This is the most recent quarter. But anyway, let's go ahead and now get into the final dividend stock that I'm never going to sell and that I'm just absolutely obsessed with and this industry. Let me go ahead and show you that right now. All right, guys, for the final dividend stock I will never sell for the rest of my life. I had trouble deciding which one to do, so of course I'm never going to sell my Nike shares. Of course, I'm never going to sell any stock in this portfolio, but I didn't know which one to pick, so it was either between Nike or CubeSmart, and I'm going to go over CubeSmart for this video because this company is really boring, but the returns are no joke. Look at this. This self-storage REIT is literally just a couple dollars or literally $1 off all-time highs. So this company actually has to pay out most of their income in the form of dividends by law. So they have a really high 3.77% dividend yield, even at all-time highs. That's very sustainable. And we're actually up 33% on our shares, which is pretty cool. But for REITs, because these are taxed differently, you don't look at net income. So this is their net income. You don't actually look at this number. It was $94 million. We actually want to look at the net income plus the depreciation and the amortization, which is super important for real estate stocks. So that is this number right here. It's known as the core FFO. It sounds a little confusing, but just remember this number. In the most recent quarter, they made $170 million in the most recent quarter, and let's see how much their dividend cost. So their dividend only cost $115 million. And some of you say, well, that's still a really high payout ratio. Well, it's because, remember, these companies have to pay out most of their income in the form of dividends by law. So in my opinion, they actually have a pretty healthy payout ratio. On top of that, this company is not diluting you. Look at that. You've only been diluted 0.15% year over year, which is literally nothing. So they have the same amount of assets from 1 year ago, and they're growing their numbers up 6% year over year. I mean, that's really impressive to $170 million. So I now actually want to take you through their investor presentation and show you why this company is so interesting to me, because it's really the sector that they're in, and I want to show you why it's so attractive. All right, so here's CubeSmart's most recent investor presentation, September 2024. So I haven't even looked at this one. It's the most up-to-date presentation. So let's go ahead and get straight into it. This company has nearly 1,500 properties. They're in the self-storage industry, and they have a triple B rating from S&P Global and Moody's, which is super important. There's a lot of safety in, being credit rated from S&P Global and Moody's. But check this out. This is the attractive industry of the self-storage industry. So look at this. This is the self-storage REIT versus the average RMZ. This just means the all other REIT sectors combined. So as we can see, self-storage has always outperformed the other REIT sectors. And here's why. They have high margins because they have low expense, low CapEx requirements, because it's literally 4 walls and a sheet metal door. That's all it is. And short-term leases. So since they're month-to-month leased, they say it allows for rapid repricing in response to changing economic conditions. So what that means in a nutshell is if inflation comes back, they're easily able to capture that inflation that month. These other long-term leases, which I'm a big fan of the triple net leases, but they're not easily able to capture inflation if it happens, when the self-storage REITs easily can. So that's what I really like about them. Here's their diversified portfolio. So most of their portfolio is in New York, but check this out. You see how some are light gray? So the light gray ones are states with managed stores only. So they're in their management program where these properties get to use the CubeSmart name, but they pay them a fee, kind of like a franchise fee. They pay CubeSmart a fee every single year, which is pretty cool. But the ones in red are the ones where they own them. They own the land. They own everything about the property, which is pretty cool. So here's the most important slide from this whole investor presentation, and I really want y'all to understand this. Look at the average 3-mile population density. Look at how it's way higher than all their competitors. So this means it means what it means. The average 3-mile population density, it's the highest out of all of them. So this is the market where the people would need self-storage the most. And we can see the average 3-mile medium household income. So it is the highest, very slightly from public storage and extra space storage, but still it's the highest. And this is the most important one right here. So that's really important. And this is the percent of owned stores net operating income. You can kind of see the different markets from that. But also on top of that, here's another huge slide for the company. So look at their portfolio composition. A lot of it, like I said, does come from New York, but that's also where that's also where the highest 3-mile population density is, in these big cities in New York. And that's where they literally own the New York market, which is crazy. And check this out. They have the Class A properties that create vibrant billboards for a brand. Like, look at this. If you drove past this property, I mean, how could you not look at that? That's a very cool looking property. That one's probably one of their better looking properties. That's really impressive. And check this out. They have the lowest supplied market. So the outer boroughs is 2.6 per capita, the lowest nationally, and less than half of the national average of 6.3. So the average is 6.3 square feet. They're at 2.6. And on top of that, there's one more thing that's kind of cool about this. The supply is waning, so competition is going away because legislative changes removing self-storage eligibility from the tax incentive program. So if you're a new self-storage property, you can't get these new tax incentives that all these old ones got. So these older ones are grandfathered in the tax program. The new ones aren't. So it's hard to compete with CubeSmart in this market. So that's what's crazy. And I'll also go ahead and show you how much they're making in service fees. So yeah, here's their robust portfolio growth. Look at this. So this is the segment of their managed stores. So look at their managed store where they get all the income from. It keeps going up every single quarter. Their wholly owned stores have kind of stayed flat, but that's all right because their management is going up and they get a fee off that. So let me show you how much they're making in fees. So it should be this one right here. So yeah, look at this. They have 879 properties. They make $37 million of pure money, of pure fees with just their managed stores. And that may not seem like a lot, but this is a growing annual fee that they will get, which is pretty cool. And like I said, they have huge financial strength. They're credit rated from Moody's and S&P Global Triple B. Their net debt to EBITDA is 4.1x, which is down from the 2021 level. But this is for 2023. I wonder what it is in 2024. I'm sure it hasn't changed much. And debt to gross assets at 38%. So that's pretty fair. So that's what I really wanted to show you about CubeSmart. So this is why I really love them. And oh yeah, look at their efficient expense management. So it looks like their peer average includes EXR, PSA, and NSA. And we can see that they have kept their expense fees well under what the competition has. So that's pretty cool. And we can see this is the number we want to look at, the adjusted funds from operations per share growth. And we can see it's very consistently growing in 2023. This hasn't updated for 2024, even though this is the most recent investor presentation. I wonder why. I guess because the full year of 2024 hasn't ended. It would be kind of cool to see like a year to date, but oh well. But yeah, guys, that was pretty much my video. Let me know in the comments if you have any advice for me, or if what are your stocks that you would literally never sell? Do you have some stocks that you just love so much that you never sell? Those are kind of some of the ones I showed in my video. But anyway, don't forget to drop a like on the video. Remember, none of this is financial advice. This isn't, I'm not telling you to do anything, buy or sell anything. This is all just my opinion. And I hope you guys have a great rest of your day. Seriously, thank you for watching. My name's Nathan Rock.